Good evening, everybody. Whoop. Okay, we've been going on a kind of a program or kind of a well, push for people to do a what do I say, a two-pronged learning process. First of all, you want to learn candlestick analysis in general. That's the signals, that's the patterns, and understanding what the psychology or the investor sentiment was that created those signals and patterns. So I always kind of remind people that if you can recognize a signal and understand, Edward, yes, we're going to get to that. We're going to get, this is going to be kind of a mixture um, with the best friend being one of them. So don't worry, you'll get more information than you anticipate. Um, Oh, let's see. Now I forgot what I was saying. That's just great. Must be the what do they call it? Old timers disease. So what we've been kind of pushing is that if you learn candlestick analysis in general and understand the psychology that equates to the signals and patterns, you've probably got as good a perspective of what makes prices move as somebody that has been trading in the markets for 40 or 50 years. The one kind of compelling aspect about candlestick analysis is it's all common sense. All common sense put into a graphic depiction. That's right, a senior moment. So here's what we're going to be doing. Now we're going to go and push the other way. Everybody should know or should learn the 12 major signals. That's just like learning the alphabet. Everybody should learn visually what the patterns look like. That's kind of putting the words or the alphabet into words. But what we want to do is the one uh, not overwhelming, the one common response when people are learning candlesticks is, man, there's so many of them. I just don't know whether I can have this all sink in. So that's why we're doing this as a two-prong education for everybody, is just learn the signals and the patterns. Now, we're going to go into each one of those signals and patterns with great depth analysis. And that great depth analysis is what we're going to be doing on this Saturday. For 2 hours, we're going to be doing the Doji and the patterns and signals that relate to the Doji. So they've got it scheduled for 1 hour. You're not going to get out of there in less than 2 hours. There's just too much information. But the good part of the information is that we're essentially going to go through the basics and concentrate on the Doji, especially the strong patterns like the best friend, the left-right combo. But the other pattern setups, signal setups that you can apply to what I call the 2+2 analysis or the convergence analysis, that if you see a doji at a particular level and you know what the next pattern setup will be, you've got an extremely high probability of not only being in the right direction at the right time, but usually in a good strong trade well before everybody else starts stepping in. So the basics is, again, the 12 major signals. And the doji is the most predominant one. Now, as I have probably mentioned previously, there's about 18 or 20 combinations of signals and patterns that produce extremely high probability results. Now, everybody can't grasp all 18 or 20. So my suggestion is learn 3, 4, 5 of them extremely well, to the point where you know exactly what should happen after that particular signal or pattern, where your best entry is, how long to continue to hold that position, and when it's time to sell. And or, because we know the probabilities are pretty strong that that pattern is going to produce a profitable trade, we've always got to keep in mind the word probabilities. So not only do we want to know when to get in and when to keep that trade, but we also want to know when to get in and when that trade is not working to get right back out of it. That's the concept of cutting your losses short and letting your profits run, that every money manager or every investor guru would tell you to do that, but they never tell you how to do that. It's very simple visual analysis when you're using candlestick signals based upon knowing what investor sentiment should be doing after a signal. What are the strongest pattern of those you listed? Don, that's what we'll be going through. There is a in the members area, there is a a training video of the top ranked signals and patterns. So we're going to go through some of them right now. So these are the signals right here, the 12 major signals. There's about 8 patterns that are very recognizable. But when we go through the most recognized signal, the Doji, very simple to recognize. It's where they open and close approximately at the same level. They've got different names. If it's a small trading range, they call it a star Doji or Doji star. If the trading range is big, they call it a long-legged Doji, dragonfly Doji because it looks like a dragonfly Doji, and a gravestone Doji. And the Japanese race traders always illustrate by saying that the warriors came out of camp, went into battle. By the end of the day, they were beaten back into camp, leaving their dead all over the field, thus the gravestone Doji. So another element of indecision is a spinning top, where the body is a little bit bigger. It looks like a spinning top. But the Doji and the spinning top have a very basic analysis. It shows indecision between the bulls and the bears. So the Japanese race traders, if you kind of learn each signal and pattern, you know there's maybe 2, 3, 4 rules to each one. And basically, if you see a Doji at the top, it's telling you they've reached an equilibrium. It's getting time to sell. If you see a Doji at the bottom, it tells you need to see bullish confirmation, or the weight of the market could continue to push the market down. Always pay heed to a Doji because it tells you there's indecision going on between the bulls and the bears. But here's the most important one. The trend will usually move in the direction of how they open after a Doji. I use the term next day. Remember, these signals and patterns work as effectively on a 10-minute chart, a 1-minute chart, or a daily chart. And everything that you see in a candlestick chart is just, it's just common sense. There's no trickiness to it. And the Japanese rice traders illustrate for us what normally happens in human nature. Where do most people buy? They start buying exuberantly at the top. My top is using stochastics. If it's over 80, it's overbought. If it's below 20, it's oversold. So logic just says if you see a candlestick sell signal in the overbought condition, the Japanese rice traders say start watching for selling. So the further away, and here's the T line, which we'll also be addressing. So all the elements that we're looking at and these charts that I usually mention very quickly, we're going to go into, I guess, scrutinizingly detailed analysis on Saturday to kind of put all the probabilities of using the signals uh, so that you've got a clear indication of what's happening. If they gap up in the overbought condition away from the T line, that's that exuberance. Now, there's a difference between seeing it open here and close here. That doesn't show indecision. The fact that they did a doji after gapping up said start watching for profit taking. So everything that we're going to be working on is just pure common sense of seeing a doji in the overbought area, get ready to take profits. And the bigger the signal, like anything else in the candlestick analysis, just tells you there's indecision going on, the bigger the decision. And then again, if a doji means indecision, a long-legged doji means more indecision. And then the doji rule, which is what will make you tons of money. The price trend, or the price of the trend, will usually move in the direction after a doji. So if you see a long-legged doji in the overbought condition away from the T line and it opens lower, the probabilities are pretty strong. You want to start taking profits immediately. So this is not stuff that just happens every now and then. This is just common sense stuff that works almost on a daily basis. Everybody was watching Tesla here for the last few weeks, and it just started skyrocketing. And so what are all the elements that we can see about getting ready to take profits? You're in an uptrend. You're climbing back up in the overbought area. They start gapping it up. You start moving away from the T line. Just this factor right here, even when it was trading up here as a big green candle, told you there wasn't a sell signal yet, but what would get us prepared for the sell signal? Just the fact that the distance away from the T line was our alert. So there's obviously a tremendous profit up here versus back here doing a potential sell signal and down here confirming the sell signal, because the logic always tells us using the T line that if you see a candlestick reversal signal that far away from the T line, where do you think it's going to move back to? Back to the T line. So how do we take profits up here without even a sell signal yet? Just very simple common sense of candlestick analysis. If we know we're too far away from the T line, then we flip to our 10-minute chart. And we just have one simple strategy at that point. As long as it continues to trade above the 10-minute T line, 10-minute T line, if it's trading up here, it doesn't close below the T line, still trading up, put a stop here because it's up pretty far. Moves up here, move your stop up, move your stop up, move your stop up. And notice what happened when we breached the T line with a little 10-minute doji, little kind of almost shooting star. When it came back through this area, what happens to human nature? If one person sees it selling off, they're selling off. It means everybody else starts selling off. Look at the profits that you would have maintained by just doing that simple strategy. All right, great, Jason. So this is kind of the simple things that we're going to be looking at to say here's where we've got enough evidence based upon human nature to know that we want to be taking profits up here based upon the 10-minute chart. So even if we didn't close it up here, the fact that it closed back down here as a doji, as it gapped up that far away from the T line, if you happen to have been out playing golf or fishing when it was trading up here and you came in before the end of the day and it was trading here, you knew at least to start taking off at least half the position, if not closing out the position. Why? Because you're still a heck of ways away from the T line. If you didn't close it there and they gapped it down, you should be closing here. Why? Because there's your doji rule. where do you think the next target's going to be? Back down here. So this is what gives us the clue to either be taking profits up here, or if you came back from lunch and it was trading back down here, that tells you there's been a major change of investor sentiment. On the bottom side, just again, simple analysis. Where do most people sell? They panic sell at the bottom. When you see a gap down in the oversold area and then see a doji, that tells you now you can look for what might be a reversal. What would be a reversal? They open up positive the next day. Not only do they open up positive, but we use one of the factors that most investor teachers or gurus or managers tell you to stay away from. Stay away from the gaps. Hog driver, yes, we'll get to the live charts here in a little bit to show you how the doji works effectively, again, in Tesla. So there's that gap down. There was telling you start looking for a buy. That tells you can be buying here. What's our next target? To see what it does there at the T line. So everything that we learn is going to be utilizing the doji in a multi-day pattern. So again, your best friend is the doji followed by a gap up, especially coming out of the oversold area. Do you use Bollinger Bands to see how far it went off the T line? No. But that doesn't keep you from using Bollinger Bands. I just don't need to use Bollinger Bands. But the nice thing about candlestick charts that I discovered from the very beginning, now the very beginning was back in the 80s, late 80s, early 90s when I first discovered candlesticks. I'd been a stockbroker for 8 years and got out of the business because I realized that most brokerage firm analysts don't know what makes prices go up or down any more than anybody else does. And then when I started looking at candlesticks, the basic concept was very logical. Prices don't move based upon fundamentals. Prices move based upon the perception of fundamentals. And that's all candlestick charts are, the graphic depiction of what's going on in investor sentiment. What they're thinking, not what they're projecting, because the candlestick signals are the decision-making results of everybody buying and selling. Don, bring that up when we do the live charts. So if I see a doji and they gap it up, and notice in this case they gapped it up at the T line and went positive, the reason we call it the best friend is not only is this telling you there's going to be an uptrend, but it's usually going to indicate a very strong uptrend. Look at our morning star signal. Remember, a down day, a day of indecision, and then an up day. Notice what the up day did. This day needed to close more than halfway up this candle. And in this case, it closed above the T line. And it came from a doji gap up. There's your best friend that's incorporated into this Morningstar signal. That tells me not only do I have a strong reversal candlestick signal, but I've already got force coming in on the upside with that best friend signal. And if I can see something that has an additional qualifier, meaning look at the distance that this doji occurred in the oversold area away from the T line. If it opened positive the next day, what do you think our next likely target's going to be? Probably at least back up to the T line. Can we get any idea of the wick lengths of candles after that best friend? It doesn't matter what the wick is. Remember, the wick is only part of the information that tells us they opened and closed right at the same level. Remember, we've got a star, a doji star, which is a very small candle. You could also call this a hammer signal. Remember what the ultimate hammer is, where they open it at the top, take it down, and come right back up at the top. So it doesn't matter what you call it or what the magnitude of this wick is. Now, obviously, the bigger the wick, the more compelling there's been a change of investor sentiment. But the important factor is what type of signal did it do down here? So if I see something like this and they gap it up, that tells me two things. The probabilities of heading up is pretty strong, and the probabilities of it being a strong uptrend is pretty strong or very strong. So the bigger the signal, we also know what to expect after our best friend signal. There's our 45-degree, and how long do we hold this? Until you see a candlestick sell signal and a close below the T line. So everything that I have learned through the years, which took a while, unfortunately, is going to be incorporated into this session because it takes everything that we know are strong signals, like the left-right combo. Left-right combo is a doji. Now, the doji should have warned us already in the oversold area at the bottom of the downtrend, right smack dab on the 50, and the following day, we have a bullish engulfing. That's a left-right combo. The left being that little jab, the right being that big roundhouse right, telling you there's a change of direction. Now, if I'm doing 18 or 20 top-ranked signals and patterns, I've got the best friend as number one, and I've got the left-right combo as number two. And as you can see, both of them involve the doji. A lot of times pull back after a big gap up. Not a lot of times, sometimes, OT, that you'll see a gap up situation and they pull it. Now, again, that goes back into the realm of probabilities. Unofficially, because I've been doing this for 40 years, that I would guess that 7 out of 10 of my trades are going to be positive based upon the results of a candlestick reversal signal. Now, some of those may be 0.3%. Some of those may be 300% returns. Yes, the left-right is that bullish engulfing following a doji, that combination. SP, ask that when we do the live charts. So if I see this happening, this is what we call convergence analysis. In a downtrend, in the oversold area, a doji gap down, support right on the 50, then followed by a bullish engulfing. What did that left-right combo tell us? First of all, what we'll be illustrating is that a left-right combo is an extremely strong reversal signal, which means I'm starting to watch for buying after this point because, again, our convergence analysis, look at everything coming together that it would illustrate that this is where the buyers are stepping in. Can you get a left-right combo at the top in an overbought area with bullish left-right combo? You're not usually going to have, remember, a candlestick buy signal is most relevant when it's in the oversold area. A candlestick buy signal is less relevant when it's up here in the overbought area. It's just a signal or it's just a pattern. A candlestick sell signal is most relevant when it's in the overbought area. A candlestick sell signal in the oversold area doesn't mean very much. So it's still identifying that buy signal in the correct area of the trend. How to tell whether the price would pull back or continue to go up. If I was buying and I saw it gap up, I'm getting ready to buy. Now there's two functions, and this is getting off topic a little bit, but it's relevant. If the market was opening down 140 points on the Dow, and this was opening positive, I might not jump in. I might wait to see what happens. And if it opens and immediately starts pulling back, I'm not going to buy it because I see some sellers there, but I have a good place to buy. But if they sold this off and then came back up through the open, that tells me the buyers are there, the profit taking's over, then I can be buying. or if I see it open positive and trade down here and I didn't do anything, but I still have this coming out of this area off of the 50, I'm watching to see if they start buying. I'm suspecting they'll start buying because of all this. I might be buying here, or I might be buying here. Let's see if I've answered everything. And would you enter at the top of the doji or at the close of the engulfing bar? No, I probably wouldn't do anything on this day because I don't have a signal setting up. And I don't know where it's going to end up. But if I see it closed here and I did my scan at night, I'm saying, oh, we got a left-right combo. Now I'm getting ready to buy. I'd rather buy on the confirmation of a signal versus trying to anticipate that signal happening. Would you go to a lower time frame? No. Right now, if I was buying this on a daily, or if this was a 10-minute chart, oh, S-Fly. Oh, I'm sorry, SP. I didn't even remember what chart we were looking at. Is also, yes, it's a bullish engulfing after the doji, but it's the doji bullish engulfing combination that makes it more relevant or more powerful than just a bullish engulfing signal. Yes, so this is a bullish engulfing signal, but here's what I'm trying to illustrate. The fact that you have a doji followed by a bullish engulfing signal, that combination is what we call the left-right combo. That has much more relevancy than just maybe seeing a bullish engulfing. Now, if you saw a bullish engulfing after a down day that wasn't a doji, it would still be good, but it's even better when you have a doji. Anytime you have a doji involved with a candlestick pattern, it becomes that much more effective. A left-right combo, smack dab off the 200. Stochastics and the oversold coming up. The probabilities are extensively strong that this is where everybody was buying. And we have the doji sandwich. Doji sandwich is very simple to identify, and this is how we use this effectively. We see a bullish candle, and then a doji. Not real powerful, but what do we know about a doji? The doji rule. If it opens positive and trades positive, we can kind of figure that this day right here is going to be the same magnitude as this day right here. So what does that tell us? It tells us this bullish signal is confirming, number one. Number two, it's telling us the T-line's not going to act as resistance anymore. This is a day that if I'm prepared for it, I can be buying, knowing that the probabilities are with me. And that's not the greatest chart to show this illustration. I'll find some other ones. Kind of the same thing right here. Do we want to buy before it gets up above the T-line? Well, if we're waiting for confirmation, but now the better confirmation is the doji sandwich. Now if it opens positive, we can be buying immediately because we know what the results are after a doji sandwich. And I don't even think I've got a McMuffin. I didn't. Yeah. So if we see that doji type day, this case it's kind of a doji hammer day, simple doji rule. If it opens positive, what's it telling us? We've got a doji sandwich in progress, and it's telling us the resistance level of the 50-day moving average isn't there anymore. We can be buying aggressively. Now back to somebody's question, is it possible that it could open up and then immediately sell off or eventually sell off? Yes. But the probabilities are we're seeing bullish sentiment taking over. But we also have that probability that if this doesn't, if this opens and trades down here and doesn't work, you close it right back out and you go find a better place to put your money. Yes. Yeah, we'll have this session. It's recorded. We'll get it out to everybody that wants it. Yes. Left-right combo is any type of doji, any type of day of indecision. Now, the Doji versus a bullish flutter kicker. Only difference in this is you've got a down day, and then we know what sets up a bullish flutter kicker. They gap it up above the previous day's open, and does a Doji. Also makes this very simple. The Doji rule says if it opens positive, we want to be buying immediately, because if they're going to trade it positive, this becomes that bullish flutter kicker. A bullish flutter kicker is basically a kicker signal with this little flutter in between. All this really does for us is gets us ready, knowing that we can be buying on a positive trade the next day. Is that correct? You are using the 3T line? No, the 8 exponential. I'm sorry. For those folks that are new, the moving averages on these charts, the blue is the 50-day simple moving average. The red is the 200-day simple moving average. I think this is the 34 exponential, which is not a major indicator, but it works effectively. But the 50 and the 200 are on our charts because every major money manager in the world uses those as making their decisions for their portfolio. So we don't have them on here to make our decisions about what to do with our trades. We have them on here because we can easily see what everybody else's decisions are at those levels. So the graphics, of candlesticks are just showing you what the decision-making process is of everybody else. Now, the T-line is the 8 exponential moving average. The T-line is probably the most effective trend indicator I've come across. I'm going to get back to the Bollinger Bands question that I forgot to answer earlier. There's a very simple rule about the T-line. The T-line, if you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line. And I say and a close below the T-line. Look what happened right here. Kind of had a bearish harami and it sold off, but it didn't close below the T-line, telling us our uptrend was still in progress. The caveat to that was up here. The caveat is if you move too far away from the T-line, the probabilities are that it's going to come back and test the T-line. Now, somebody was asking about the Bollinger Bands. The nice thing about candlestick analysis is we know that the basic chart works, the basic signals and patterns. These aren't newly discovered signals and patterns. These are what the Japanese rice traders had recognized and utilized over the past 400 years. And I always make the illustration that the Japanese rice traders did not become wealthy trading using candlestick analysis that they developed. They became legendarily wealthy. They were the financial powerhouse in Japan for centuries. And they did it off the most boringest basic commodity in the world, rice. And what it illustrated was, again, that prices don't move based upon fundamentals. Prices move based upon investor sentiment. So here is the, I say quintessential definition of candlesticks, but I don't even know what the definition of quintessential is. But if candlestick signals are the graphic depiction of investor sentiment, showing you who's winning between the bulls and the bears, and the T-line acts like a natural Fibonacci characteristic, a natural support level of human nature. When you combine those two, you've now got an extremely strong probability trading strategy. And the reason I needed something like this was because I was the worst investor in the world. What kills most investors? Their own emotions. And when you learn what the information is built into candlestick signals and the corresponding or the correlating indicators, you basically now become an analyst on what's happening in price movement versus being pushed around by your own emotions. Back, which one? OT. Yes, that was back up. Where are we at? 42. The whole expectation of taking profits up here was the fact that you've moved that far away from the T line. Oh. How does automated trading, and they don't affect, everybody asks, well, what about computer generated trades? Remember what makes computer generated trades? Somebody's human input on what should happen based upon their signals and patterns. Yeah, humans, there you go, Casey, thank you. Humans program those computer programs. So candlestick signals work just as effectively on the sell side. If one doji means indecision, a series of doji means greater indecision. So there's a very simple place to put a stop if you were waiting for this to go up. If it came back down through the lows, which told you they were coming down through the T line, it told you which way they were moving. So you've got some simple little trading setups, which we call the double doji. Comes up, pulls back, does a doji. The third day after the big move, you can see that the pullback was very indecisive. This becomes a very strong trading day. Pull back, gap up, tells you the consolidation was not very compelling. You can be buying. So the doji setups are as good a setup as any. I mean, if you don't want to burden yourself initially with trying to learn 18 or 20 good trade setups, you could take the doji and have more trades than you'll ever be able to handle just off of that one signal. So if you see something like this, we already know what could happen. If it opens positive after a dark candle, then a gap up, if it opens positive, what's it telling us? We can already factor. You got a bullish flutter kicker, number one, and number two, it's telling us the T line is not acting as resistance anymore. So this is just common sense. It gives you immediate information to tell you what's happening at a breakout point. So there's my doji. And if I know my simple doji rule, if it opens positive, I got a doji sandwich breaking me out into a J-hook pattern, wave 3. If it opens lower, I've got a double top, close out the position. This is not rocket science. This is seeing exactly what would happen after a doji. There's our doji sandwich, a positive open after the doji right at the breakout level. We can be buying immediately. And this is the advantage we have even if you're a day trader or a swing trader. It's putting you in situations where the probabilities are not only strong that you're moving in the right direction, but you're probably going to be more apt to be in situations where the profits are fairly large just because you're hitting a breakout situation. So if I see something like this, where the doji sitting right here, if it opens positive, what's it tell me about my resistance level of the 200? It's not there. I can be buying immediately. So the dynamic doji, I call it the dynamic doji because Saturday we're going to be going through all the different situations that a doji works effectively, not only just to recognize the signal itself, but if you understand the psychology that creates these patterns, now you're analyzing based upon what the expectations are, that you don't have to listen to anybody else because the patterns and signals work the same way time after time. If they didn't, we wouldn't be looking at them today. The reason we're looking at them is because they create good enough results that uh, that we want to be identifying what happens with a high probability after a signal. What would you do if you see 2 or more consecutive dojis? Roger, let me see if I can find those. That's called a series of dojis. And remember, even on these, let me go back up here a little bit. Where did we have our double doji set up? If you know what a doji represents, it's indecision. So if you've got an uptrend starting and it pulls back indecisively, then was it Maxar? I forget what Maxar. Anyways, we're going to go to live charts here in a second. But essentially all we're doing is identifying when our next move is based upon knowing that this is not decisive selling. This is not decisive selling. Now we get ready for this move. Yes, Edward, all those sessions are recorded. And as I say, the hour advertising, you're going to be lucky if it's less than 2 hours. All right, so hold on for a second because I want to illustrate the fact that dojis will provide more trades than you'll ever be able to handle. Now, why we're here, let's just take a gander at the overall market trend. Notice today's trading in the Dow was indecisive. Notice the doji right here, and it opened lower the next day. Where did you think it was going to move, or the Dow was going to move to? They were coming back to test the T line. Now we can analyze. Hold on for a second, Coleman. I'll get to all these. Now we can analyze what our overall trend is right now. As long as we're staying above the T line, we know that we're in an uptrend. We also know that this uptrend has been relatively strong for a couple of reasons. Because every time it pulls back, profit taking, we have another uptrend. Profit taking, another uptrend. Profit taking, another uptrend. And when do we know when the profit taking is over? Because usually you'll see a candlestick signal. If you recall, when it did the Harami inverted hammer signal, it was a very simple analysis. If it opened positive the next day, you wanted to be buying because we know the statistics, or at least you should know the statistics from what I've repeated over and over. If you see an inverted hammer in the oversold area, even though the inverted hammer is probably the least, I would say, least frequent of the 12 major signals, it has probably the highest probability that if it opens positive, you've got a 95% probability or greater that you're going to be in an uptrend. The blue line in this case is the 50-day simple moving average. Red is the 200-day simple moving average. All right, we're going to do kind of the lightning round here just to show you how effective the use of a doji is. This is what happens when you see that series of dojis. Now, if there was 2 dojis here and a big candle, I consider that a morning star signal. If it goes to 3 or more, now it becomes a cradle pattern. But what does this tell you right here? Indecision, indecision, indecision. There's the decision. Look at your series of dojis down here. After a gap down, now you see them gap up through this indecisive trading range, and notice how they gapped it up. There was your doji, 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 now a bullish engulfing, coming out of the oversold area, gap up above the T line, and then look what happened here when it came up through the 50. Doji, gap up, your best friend, creating more upside. So if somebody said, well, if you only had one signal to trade, what would it be? And pretty much the Doji. Because now I can recognize there's my Doji, there's bullish confirmation. What pattern can I recognize? Wave 1, wave 2, going to wave 3 of the J-hook pattern. Maxar, yeah, there, look at your morning star signal with a Doji that started your uptrend. Then kind of a Doji sandwich right here. Now Doji, if this opens positive tomorrow, what's it kind of telling you? You got a wee little mini wedge. If it opens positive, that's your double Doji. You're still trading positive. Yes, so anytime you see a Doji, whether it's at the top or bottom, if you see more than one, a J-hook pattern is bah humbug. A strong price move. Then it pulls back, the consolidation, and then there's your J-hook. It starts the next wave up. And what is the next wave up? If this is wave 1, wave 3 will be approximately the same as wave 1. I say approximately. They usually get pretty close, but you hold this until you see a sell signal. Now, the most important factor is the analysis is that you have a possible J-hook pattern. The actual analysis is, first of all, you see whether they can break through this level. If they fail up here, what do you have? You've got a double top. You close out the position. If it goes through, now you've got the prospect of a wave 3. But if it comes up here, not anywhere near this magnitude, and does a big bearish engulfing, you get ready to close out the position then. Where is the buy signal? There was your morning star signal, followed by a Doji sandwich. This is what we call a McMuffin. A morning star signal is your big down day, a day of indecision. The third day closes more than halfway up this candle. And in this case, it closed near the top of that candle and closed above the T line. That alone is one of your 12 major signals. Now you've got kind of a Doji sandwich. So we've got a morning star signal followed by a Doji sandwich or a morning sandwich. There's your McMuffin. Now, what does a McMuffin imply? Well, first of all, the morning star signal implies there's been a reversal. And what do we know about a Doji sandwich? It implies there's going to be more upside. So you add the two together, it makes for a very compelling chart to tell you there's going to be another trend to the upside. Now, whose handwriting is this? Here's what we call the bobble pattern. Notice how it came up and failed right here at the T line. This is a type of things that we're going to get everybody's, not only their eye trained to seeing these patterns or knowing what these patterns should do, but knowing what the psychology is for creating these patterns. So notice where this pulled back to. Now remember, here's the most important thing about the T line. Nobody has the T line on their charts. So when it works so effectively, dang, I keep forgetting about the Bollinger Band analysis. When it comes right back to the T line, it's not coming back to a level that everybody's watching because nobody has the T line on their charts. It acts like a natural support and resistance level that when you apply it with candlestick signals becomes an extremely high probability trade setup. So there's a bobble breakout. Even though it traded lower today, I'd still watch for positive trading from here because a bobble breakout is basically a J-hook pattern that if you took out the 50, it'd be a J-hook pattern. With the 50 there, it just becomes much more defined as a bobble breakout. Same scenario there, Deborah. Well, this is not a bobble breakout. This is just getting ready for a breakout. There's your morning star signal. Now, if this opened positive and traded positive, it's telling you the 50 is not acting as resistance, and you would have a morning star signal and kind of a doji sandwich following it, but it would still imply the same thing, that the 50 was not acting as resistance coming off of buy signals. And once again, this is where convergence analysis takes place. Look where the bottom of this hammered doji type day occurred, right smack dab off the 200, which is where it supported before. Should you use stops on is that very or every trade? I hate stops. Lou, I do, especially when I start getting up in the overbought area. I start picking places that would tell me the bears have taken control. Neil, it works somewhat effectively. It works better over on the commodity charts. Oh, and there, thank you for bringing that back up. Somebody was asking about Bollinger Bands. The nice thing about candlestick charts is you could take everything off this chart other than the candlestick signals themselves, and they would work reasonably well. The reason for that is because they've been well researched for 400 years. So if you took everything off this chart, all the moving averages, you'd have a decent trading platform. Putting the moving averages on here just enhances identifying where everybody else is buying. And the T line, again, is kind of an indicator that nobody really knows about. Now, there's a lot of people online right now that know about it because one of my first private training students came down from Anchorage, Alaska, loved candlesticks, and he called me 6 weeks later and said, hey, put the 8 exponential on your charts and see if it doesn't work. See if it doesn't work well for you. And so the nice thing about candlestick charts is we know the basics work. We know the candlestick patterns work, the signals work. Now, whatever you want to put on there to enhance the analysis of what's happening on your charts, put it on there. If Bollinger Bands works effectively, which it works, they work well. A lot of people in our chat room use those as another indicator. But if somebody says, put the XYZ indicator on your chart and see how that works. Well, you can put it on, and if it doesn't work or improve your probabilities, take it back off. As you can see, my charts aren't very cluttered. And it's because the signals are the most important factors. Anything else that I put on just should enhance the probabilities of being in the right trade at the right time. Bah. Look where kind of your doji sandwich occurred, right here at the breakout level. What'd that tell us? Wave 1, wave 2, wave 3 is in progress. So the signals look where our doji, almost a best friend, you could consider the best friend, morning star type signal occurred, close above the T line on MPlex. Now you have another doji. If this opened positive and started trading positive, you could be buying because now you've got your McMuffin pattern. And if that day is duplicated over here, where do you think your next target could be? Right up here to the 50-day moving average. Las Vegas Sands. This was more to illustrate. Look where the big long-legged doji did. Bounced off the 200. Opened positive the next day. What other element could you add to that analysis? Well, you're getting down here toward the oversold area. And look how far away you are from the T-line. Where do you think your next likely target was going to be? At least back up to test the T-line. BCLI. Look at your best friend signal. then your Doji sandwich. Now, if I had been lucky enough to be buying right here and it was trading up here, what's my next strategy? There you go, David. Thank you. You go to your 10-minute chart, and if you were trading off your 10-minute chart, what did your 10-minute chart tell you? Again, this is a 10-minute chart, and look what human nature does on a 10-minute chart. Moves up, moves up, moves up. Where do most people buy? They buy exuberantly at the top. There you go. Somewhere up here, you start taking profits. Maybe on your big bearish engulfing, or your Doji sandwich down through the 10-minute chart. So what's our simple rule? You stay long until you see a candlestick sell signal and a close below the T line, and or you're way up here, that far away from the 10-minute chart. Do you wait for it to come all the way back down here? Now, maybe you get a little bit more decisive, and you go to your 5-minute chart. Say, all right, maybe I'm taking profits here. I'm going to see what it does back at the 5-minute T line. It didn't hold, which meant my 10-minute chart didn't hold, which meant I got out somewhere up in this range, which on a daily chart was up here somewhere before giving up all those profits. So this is, again, not rocket science. This is just common sense that if we just use some very simple trading practices that have worked well based upon human nature, which the T line is kind of an indicator of that when you're that far away from the T line, get ready to take profits. An NESR, hammer, doji, doji. This becomes your morning star signal. There's your left-right combo. This tells me I've probably got a good strong chart to be in. Yes, the hammer is, yeah, just that's kind of your hammer signal. And remember the simple rule. There's only one formula that you have to know in candlestick analysis, and that's the number 2. That on a hammer, inverted hammer, hanging man, or shooting star, the shadow is 2 times greater than the body. Or if this was my buy signal telling me to buy, where do I want to close it out? Well, if this is the candle that told me the bulls are in control, you don't want to see it close back below the halfway point of the candle that told you the bulls were in control. All right, let me go to Micron real quick. Now that's the opposite. Notice you've got a shooting star, shooting star. You're not quite in the overbought area, but where is it telling you the selling is occurring? Right here where the selling occurred before. So what would we do on this one? If it opened lower tomorrow and you were long, you close it out because likely it's coming back to test the T line. But if it comes back to test the T line, we don't know whether it's going to come back here or here. All we do know is when it got back up here to the resistance level and started showing candlestick sell signals, and it was confirming, it told us they weren't going up anymore. Close it out and go find something else. Kind of the same scenario on Western Digital. There's your piercing signal, one of the 12 major signals. There's your Doji sandwich. So if I'm getting ready to buy based upon the Doji sandwich, what do I want to see today? I want to see it open positive and trade positive and break through here. The fact that they did another shooting star, what that tell me about the strength right now? It's not there. Now, where would I be buying? If it came up through there, I've got a J-hook pattern setting up. Oh, let's see, found another one. There's your Doji sandwich. What makes this one relevant? Look where the buying started, right smack dab off the 50, and a doji sandwich that closed up above the T line. What would I want to see? I want to see that they came up through this area. Now what do I got? Wave 1, wave 2, wave 3 of my J-hook pattern. What is that? Oh, Crocs. We were short Crocs because you could see the dumpling top, then you could see the bearish J-hook pattern. High probability shorts. But notice what happened here in the oversold area. A doji. And what's our simple doji rule? What exacting is the left-right combo? Pam, that is a bullish, or that's a doji followed by a bullish. This is a left-right combo. There's a doji followed by a bearish engulfing signal, starting your downtrend. So it's the combination of a doji followed by either a bullish engulfing signal or a bearish engulfing signal. But there's our doji in the oversold area. What were we expecting? Well, if this had opened lower, we'd have a doji sandwich confirming our bearish J-hook pattern. But notice what it did yesterday. Opened positive and started trading positive out of the oversold area. What did that tell us? The bears weren't in control. The bulls were taking control. So where is the last best safety stop? Well, if you see a doji in the oversold area and you're short, you put a stop at the high of that doji, because logic says if it comes up through there, they aren't going in this direction. They've reversed it. For the last 3 years, here's a candle progression I've learned from this room. Deva IPG Bro. Here's a candlestick progression. Deva. There's your fry pan bottom breakout. Yes. And notice how it broke out with your doji best friend gap up. What's that imply? There's going to be more upside. IPG, there's your best friend. What would we be expecting? A 45 degree off of here, which was kind of the same trajectory it was before this profit taking. And bro, there's kind of your best friend. There's your 45 degree. And what's your rule on this one? You stay long until you see a sell signal and a close below the T line. They all work exactly the same way. I don't want to get too far off base because I got a whole bunch more to go through here. Labu had a resistance level right in here and opened lower today in the overbought area. Makes it very simple. If they open this lower tomorrow, where do you think they're taking it? At least back down here to the T line, which means they're not going up through. Hold on for a second. I've got a bunch more. I'll try to run through these quickly. We'll do the lightning round. PAGs. There's your Morningstar signal. There's your doji sandwich. You could be buying this one because it's broken this downtrend with buy signals. Costco. There's your bullish Harami doji right off the 34. Bullish confirmation. That's what started your uptrend. Southern Company. There's your doji. Back up above the T line. You can be buying this one because that would be your J-hook pattern. TNAV. There's your doji gap up. Notice what they haven't been able to do, even though they've waffled this around. They haven't been able to close back below the T line. This told you there's a lot of strength. Expect a 45 degree off of here. Oh, that is ugly. What happened here? Remove horizontal line. Remove all horizontal lines. There's your Morningstar signal. There's kind of a left-right combo. That's breaking the downtrend. You could be buying this one. Let's see. Tiva. Here's a perfect example of where you set your stops. Look at your little wedge breakout. J-hook pattern. Where do most people buy? They buy exuberantly at the top. Where was your safety stop? Right here. Logic says if they came back down through there after gapping up, the gap up was your alert. Common sense said if it came back down through this level, where do you think they're heading to? Back to the T-line. Let's see. We had recommended this one if it had opened positive today, but you can see the little morning star signal. This was not your pattern. This was not a signal. This is not a bullish engulfing, not a bullish harami. This is just a big up day. So what does this tell us? We don't want to pay too much attention to this, because if this was some sort of bullish reversal, the Japanese rice traders would have given a name and told us what to do with it. It doesn't. Now here's your little left-right combo after a hammer. You could still be buying this one on positive trading, especially if it comes up through here. That tells you your J-hook pattern's in progress. And CNST. Doji, Doji, Doji. The more Dojis you see down here, the more compelling the change of investor sentiment will be. Is a harami combo unequal? No, it's a different pattern. A bullish harami doji. Now, anytime you see a doji in a combination of more than one day, it'll probably be working more effectively than just a regular harami or a regular signal that didn't have a doji in it. The doji just adds a little bit of bullish probabilities to it. Look at all the little indecisive trading down here, followed by a bullish engulfing. You can be buying this one on positive trading. Because what's it basically telling you? What's it telling you? Well, after a big, giant move, look where it drifted to. Right back to the 50. Did a bunch of dojis, an inverted hammer, now bullish confirmation, and closing just above the T-line and at the 50 and at the 34. So if it opened positive, what's telling you? That's where they're buying. Where do you think your first target's going to be? There's a gap there, so at least that would be one target. SBGL. Notice how this came back up. There's your little best friend breakout. Where do you think the next likely target on this one will be? Probably back up to the top of the channel. ITSI, a T-line crunch? No. A T-line crunch comes from the other direction. You would have had a T-line kind of pushing price back up through this. This is just kind of convergence of everything. Oh, I've still got a bunch. Oh, so here's one thing that you want to learn when the investor sentiment changes. Again, on Tesla, and it came back. Notice what it did after that. All the excitement, probably the short coverage, the panic buying, and then created this signal. Then they came back to the T-line, and notice what the enthusiasm has been after that. That's usually tells you they took out a lot of the excitement. Now today they did a left-right combo. So you might watch to see if this doesn't start back up, because now you might have a J-hook pattern. So anytime you see that fizzle, there's your hanging man doji. They open it lower. This was APT. Look what's happened after that. Nothing to get excited about. and VXRT. Notice the kind of the spinning top up here, way away from the T line. They open it lower, come back to the T line. Not a whole lot of excitement. The left-right combo, yes. When I was doing a kind of quantifying them, I put the T line or the left-right combo as number 2. Gene, ego, you can stay long. You do. It's not quite a morning star signal here. But the fact that they've started bringing it back up, all you can do right now is see whether they can get up through the 200. You have your safety stop just below the Doji today, because if they come back down through there, pretty obvious that the T line or the 200 is going to act as resistance. NNVC, another one that when they gapped it up and did the indecisive trading, a spinning top type day, the fizzle went out. So this went from $2.50 to $17.50. Now it's just kind of dead. So that's what normally happens. Now I remember this because years ago, I think it was Boom, had just skyrocketed. And then it did the big doji at the top and reversed, and it came back down to the T line and jumped back in because I thought it was going to do a J hook pattern. Now this was probably 20 years ago now. But I just remember that after that fizzle at the top, that you get this told you the bulls are in control. The bulls are in control. The bulls are in control. And bam, the bears stepped in. Now you don't know whether the bulls or the bears are in control after that. AXTA, there's a left-right, a little left-right combo right here, J-hook pattern. So you look for this to come back up through the 200. And again, whoops, right back to Tesla. Tesla, a little left-right combo might mean that the indecisive trading is over. Why do I have this one on here? Oh, morning star signal. So here's the obvious. Hold right back to the 50, and there's your morning star signal. That's why we recommended that one today. Glue started with this big uptrend with your gap up doji off the 50. Look how they gapped it up, gapped it up. When you start seeing a signal and then they start gapping it up, that means somebody's very excited about getting back into the trade. Let's see. I've got some of these written down, and your little dojis right here, doji sandwich, J-hook pattern. Look for at least Etsy to go to this one or go to the 200. And M-plex. Again, that's a big, strong morning star signal that can still be bought on positive trading. So during any trading time frame, we've stayed long on this one. I think probably coming out of this little scoop pattern. But notice what it did today. There's your kicker signal. Probably more upside. Same scenario on the downside. Look what happened on SPWR with their earnings. A bearish kicker signal. At least probably the 50 and maybe even lower from here. Yes. So very simple. Stay long, stay long, stay long. But if it opens lower tomorrow, yeah, I'd close it out. They're taking profits. And Bidu, the fact that they came up here and then opened lower, you're still above the T line, but instead of your trajectory now having the prospects of moving this way, maybe it's going to be more like this. Hold on, I'm still got a bunch here to look at. Workday, that's not, yeah, that's just 2 dojis. It doesn't really mean anything in this factor other than got a wedge formation. if I was long, I'd still have a safety stop just below the T line. Did I do Williams? Yes, we did that one. Okay, Z-Lab was our recommendation last week or a couple weeks ago because, okay, your inverted hammer, your Doji, bullish confirmation, there's your Doji sandwich. So if we know there's going to be more upside after a Doji sandwich, we've got this wave, which would be a J-hook pattern, wave 1, wave 2, wave 3. So we stay long on this until we see a sell signal. That same scenario, here's your Dojis. There's kind of your rounding bottom. They gap up. There's your Doji sandwich. Wave 1, wave 2, you're in wave 3 right now on this one. Let's see, I'm going to do zoom. There's your left-right combo. You can buy this one on a J-hook pattern. ZS. There was your little Doji. Look at the Dojis down here. Then a gap up. Now you're right at the breakout level. If this opens positive, what you got going on? Wave 1, wave 2, bobble breakout going into wave 3. APPN. Oh, this was more to illustrate, look, again, where it was time to sell. So here's kind of the mechanics of knowing exactly when to be selling. You see a Doji gap up in the overbought condition. You see a Doji gap up, or you see a Doji to stay long and needed open positive and trade positive. Then you had a Doji, but what was the other element that kind of gave you an alert? Look how far you've moved away from the T-line now. But then it opened positive and started trading positive. So where's the two logical places to put a stop? If you see them trading positive in an overbought condition, put your stop where it opened. Logic says if it comes back down through there, you're probably going to get some sort of candlestick sell signal. Or you put your stop just below the Doji. Again, logic says if it trades back below that level, where's your next likely target? Back down here. And LTHM, kind of a left-right combo, J-hook pattern. You get ready to buy if it breaks out through this level. An AGIO, Doji, 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 where? Right smack dab off the 50, where? Right about the same level. It bottomed out on the pullback. And now you've got your kind of a gap up Doji. Where's your next likely target? Back to the top of the trend channel. So again, everything that we see on a candlestick chart and the analysis of everything on a candlestick chart is just common sense based upon what we know about our patterns. Look at Rite Aid. Again, Rite Aid has a fry pan bottom. You get ready to buy this one. But look what happened over here. Can't tell if that was a kicker, but a gap up. And where was it time to sell? Notice they gapped up. If it gapped up and started trading positive after the gap up in an overbought area that far away from the T-line, there's your stop right there. So this all is merely the visual analysis of what happens to human nature, or how human nature works time after time. And as you can see, just with the amount of information, this one doesn't have it, but this one's got a good chart that if it breaks out through here after the bullish Harami bouncing off the 50, you probably got wave 3 in progress. All right, that's about all we got tonight. So this was just kind of a Cliff Note version of what we're going to be doing on Saturday. And as I say, even though it says it's an hour, figure at least 2 hours. A bobble breakout setting up for our RF? Yes. Where did the bearish engulfing occur? Right smack dab off the 50. Where this bearish engulfing occurred, now they couldn't close below the T line. They're ready to come back up through this level. Okay. Whoops, I kept us way over time again. Yes, CB, that's why we've kept the price down fairly low, just to cover the expenses. I've got to pay Jim and a few other people to do these sessions. So just try to keep the price low. But I'll give you the Oklahoma guarantee that if you don't learn more than what you paid for, I'll be a son of a gun. Uber might be an evening star signal, so you have to see if it can stay up above the T line. And Luckin, get ready to buy this, especially if it comes up through this level. All right, I'm not going to, yeah, we're way over time now. So I'm not going to try to do any sessions. Cindy, it will be recorded, so you can at least pay the money and then send the we'll send the recording to you. It'll start at 10 so that we can keep the or let the West Coast have an extra half hour to sleep in. But I imagine we'll be going to at least noon, if not longer. But the whole point of these kind of mini concentrated sessions is to kind of now bring your focus right into the analysis of how to use the signals right at relevant breakout points or confirmation points, so that you're not, so the guesswork or the guessing kind of goes out of your analysis. You know exactly what to expect based upon a signal. All right, everybody, have a good evening. We'll see you bright and early in the chat rooms tomorrow. We'll see you then.